In May, the FOMC delivered a 50 basis point rate hike. The market subsequently franked the FOMC's assessment that additional outsized increases need to be an option at coming meetings by effectively pricing in another 3 50 basis point hikes from June to September, to be followed by 3 25 basis point increases to a peak Fed funds rate above 3% mid-2023. Since this time, the US 10-year has traded around and briefly above 3%, as the US dollar tested 20-year highs on a DXY index basis. Clearly, a need to aggressively fight inflation has been priced into financial conditions. The obvious cost has been to equities, but the more important question to ask is what effect it will have on the real economy, and consequently, is such an abrupt turn for monetary policy appropriate? The obvious place to start is the current pulse of inflation. While annual headline and core inflation decelerated in April, it was only at the margin to 8.3% and 6.2% respectively. On a month-on-month basis, core inflation rebounded from a moderate read of 0.3% in March to 0.6% in April. Annualising the average of the past 2 months points to current momentum of around 5.5% versus near 7% in the 5 months to February and 10% a year ago, when fiscal support saw demand for goods surge at a time when global supply was extremely tight. While heading in the right direction, clearly 2 months do not make a trend. Also, the current pace of core inflation is still a multiple of the FOMC's medium-term 2% target. We therefore have to assess how disinflation will progress from here. Now, I mentioned earlier that the market's bullish short-term expectations for the FOMC have already been factored into the 10-year yield. At the same time, they have also been priced into the 30-year mortgage rate and the shorter-term rates that businesses borrow at. But these rates are fixed rates and so will only affect activity at the margin, likely slowly. Also, while equity prices have recently jolted lower, in aggregate they are still much higher than prior to the pandemic, and house prices continue to rise. So it is unlikely that a wealth-driven slowing of demand is coming. The handbrake for inflation therefore must come from household income, specifically the portion left over for discretionary spending once essentials are paid for. Here, there is very good cause to believe further disinflation is on the way. Simply, all measures of US inflation are running at a multiple of wage growth and being driven by the cost of life's essentials, such as food, shelter, and fuel, which the FOMC have little to no control over, hitting households' discretionary capacity to spend and sentiment. Wage growth is also decelerating, so it will likely take until sometime in 2023 before real income and discretionary purchasing power develop a firmer foundation. By that time, remaining supply pressures related to past and existing disruptions are likely to materially recede, meaning any pickup in demand-driven inflation will be of limited concern. Westpac therefore continue to expect that the FOMC will only need to raise the Fed funds rate to 2.625% by the end of 2022, after which they will remain on hold while remaining supply-side pressures abate, taking headline and core inflation back towards the 2% target. If we are right, the FOMC will be able to cut the Fed funds rate back towards 2% in 2024 to sustain growth near potential and a strong labour market into the medium term. The key risk to this soft landing expectation is a further escalation in global conflict, with consequences for supply and inflation that feed into expectations for wages. Potentially as worrying for the medium term would be if the FOMC or the market doubles down on their expectations for rates, causing another aggressive tightening of financial conditions to contractionary levels. Given where we stand, this would come at a heavy cost for activity and the labour market, and depending on the hit to sentiment, could persist for quite some time. Rest assured, we will continue to assess and inform on these risks. We'll see you next time.